When it comes to investing, intrinsic value is one of the most important things to know about. If you can't calculate the intrinsic value, then how can you know if you're overpaying for a stock? Just like how Warren Buffett says, the critical investment factor is determining the intrinsic value of a business and paying a fair price. He calls it the margin of safety. Hey guys, this is Invest Crest and make sure you smash that like button and watch this video till the end as it helps the channel out. So why should we calculate the intrinsic value of a stock? That's because the value and price of a stock are two different things. Since the stock market is an auction-based system, the trending companies tend to be sold at higher prices and sometimes higher than their worth. And it's the opposite for the story of companies that are not in the news. Now assume there is a store at the corner of your street that's in a good spot and you've always been fascinated by it. So one day you finally decide to buy it. Now how do you calculate the approximate value of this store or business? So you take the financial statements of that business of the last 10 years and analyze them. You read the income statement of this business and observe that it has consistently made a $10,000 profit for 10 years every year. Now the part comes to decide its intrinsic value. Now you know that the business profits $10,000 yearly on a consistent basis. Now you want a 15% return from this investment yearly that you want to make from the investment. So the formula to calculate the value of this business is to divide its yearly profit by the return you want on a yearly basis. That is, you divide 10,000 by 0.15, that is 15%. Now we get $66,000. Now let me explain what just happened. Imagine you now pay this $66,000 and buy the business, so all future profits are now yours. Since we wanted a 15% return, we will now get $10,000 yearly as profit from this business, and this is 15% of our total investment. This is called the discounted cash flow method. To know more about this, I have an entire detailed video on this topic, so you can click the I button on your screen or link in description. We are bringing the future profits of the company in the present day by discounting them. To put it simply for now, it's the current value of the future profits which are adjusted with inflation. To know more about inflation, click the I button on your screen or link in description. I have an entire detailed video about inflation. The $10,000 of today will be worth less than the $10,000 in 10 years time. So hypothetically, in a couple years time, that $10,000 yearly would amount to $1 in today's terms. So these values have to be taken into consideration while buying the business. Now that this is clear, let us quickly deal with price to earnings ratio, that is a PE ratio of the company. This is the price of the company divided by its earnings, that is $66,000 divided by $10,000, that is 6.66. This means that to earn 1 from your investment, you are spending 6.66. Now if the business owner refuses to sell for 66,000 and asks for more, then we have to reduce our rate of return to, let's assume, maybe 10%. Then the value we have to pay for the company is 10,000 divided by 0.1, that is $100,000. Thus we always aim to get the lowest ratio as a result in higher future profits. Now you know how to calculate the intrinsic value of the business, and using the PE ratio you can calculate the value of the stock. The lower the value, the better. So as you can see over here, I have googled for a stock screener which basically shows us how a stock is doing, how a company is doing. So let's just pull up one of these stock screeners and you can see the companies listed in this particular country, in this particular stock exchange are listed over here. So let's just open one of them. And immediately you can see the intrinsic value right here is stated, and it says the current price is more than the intrinsic value, which means the current price at which the stock is trading is more than what the actual value of the company is and what the actual value of the stock should be. If you can see the PE ratio, it says it's 35, which is on a much higher end. As we previously discussed, the lower the better. You'll find many companies which are at a higher PE ratio, even more than 35, which means they're extremely overpriced. Some people tend to invest on that company thinking that they will go higher in price, their profits will considerably increase, but that's a risk that they're taking. and you can clearly see all the things are stated over here. These are basic values, these are basic estimates of the company, and this is how an intrinsic value helps an investor estimate a proper price for a company and then buy the stock. Now let us quickly talk about another important thing you may consider, that is the margin of safety. Now according to our assumptions and calculations, the business will give us a $10,000 annual profit. But what if it reduces? What if there's another store open nearby due to which the profits fall to say $8,000 yearly? So we have to take these differences into account, or rather we tend to take them into account and offer a proper calculated final price to the business owner. So in this case, instead of offering $66,666, we may choose to offer just $60,000 or $55,000. The lower the better, of course. This cushion we create for ourselves is called the margin of safety that we add into our calculations for the investment. So that's all time for this video, guys. I hope you learned something and enjoyed it. Be sure to hit that like button, comment what you want to see, or if you have any questions, and subscribe for more such content.